So interest rates are going up again, and you'll likely hear this a few more times in 2022, but exactly how many times are we gonna hear it, and what does it mean for your money, and how does it technically control inflation? The media keeps reporting that rising interest rates will keep inflation in check.
Jay Powell vows to keep inflation in check.
We have to keep inflation in check.
Keeping inflation in check.
Keep inflation in check.
And you might see that statement, and yet almost everything across the board is still way more expensive. That includes gas, which is $7 a gallon here in the Bay Area, and nationally it just hit all-time highs of $5 per gallon. Groceries, electricity, cars, used cars, and housing costs are all up as well. The reason why raising rates hasn't curbed inflation yet is that typically it can take usually 1 to 2 years for the effects of raised rates to even play out in real time. In order to at least do something, the Federal Reserve, which is the nation's central bank, is charged with keeping prices stable. They have to use their main tool at its disposal, and that is to raise the federal funds rate. The latest rate hike has the federal funds rate being raised 0.75%, or it's known as 75 basis points, which increases the overall rate to between 1.5 and 1.75% at the high end. This is the single largest increase in the federal funds rate since 1994. So don't worry if that all sounds like a bunch of financial jargon to you. I'm gonna break it down so that you can easily digest it today. So before I do that, let me rewind a bit and explain what the federal funds rate is with a little bit of a story. So let's say you're in a pinch because you really wanna buy a new pair of Yeezys. Like I saw this ugly pair of Yeezys the other day at the store that was priced at $450. I'll put it on the screen right now. So let's say you want these Yeezys. You ask your buddy Trevor for a loan of $100. He laughs at you because they're ugly, but he loans you the $100 anyway, and he wants you to pay him back $105 to make it worth it for him at the end of the year. In that sense, he's created kind of like a mini loan to you in the amount of $100, and that extra $5 you need to pay back is affected by an interest rate. When you borrow money, let's say you borrow it from the bank, you'll have to pay it back usually plus a little bit of extra because they don't just want to lend you money for free. The federal funds rate is the interest rate that commercial banks borrow and lend to each other, and it affects almost everything in our financial lives, including the rate at which they loan you money. If you take out a loan, you want the interest rate to be as low as possible so you don't have to pay that much money back. On the contrary, if you're putting money in a savings account, you want the highest interest rate as possible because that means you're going to be earning money on your savings. Now here's the interesting part though, just like you and me, we're the bank's customers. Well, commercial banks like Chase or Wells Fargo, they're customers of the central bank. That means they can deposit their money with the central bank and earn an interest rate on their reserves. So when the federal funds rate is increased, a bank like Chase might be able to earn more from the central bank instead of loaning it out. So if they do loan their money out, they need to raise their interest rate that they're charging, and that's for any loan, including mortgages. When interest rates rise, it directly and indirectly affects spending behavior. Higher interest rates means that businesses will find it more expensive to borrow, so there's less economic activity, fewer jobs are created, and less money overall. The whole point is that hopefully spending and investment slows down so that businesses become reluctant to raise their prices, which should rein in inflation. So I've covered interest rates in previous videos, and in the last one, it was thought that by the end of July, we would be seeing an overall interest rate of 1.75%, and that would be on target for a 2.523% interest rate by the end of the year. Well, a lot has changed. After the last inflation report, the Federal Reserve has decided to get more aggressive and increased it by 75 basis points or 0.75%. In addition, Jerome Powell, the chair of the Fed, said that another 50 or 75 basis point hike would be likely in July, and it is now expected that we're going to see at least an interest rate of around 3.4% by the end of 2022. Jerome Powell and the Federal Reserve have been facing harsh criticism lately for being slow to end the stimulus, allowing inflation to climb to 40-year highs, despite repeatedly saying that they would do whatever it takes to cool prices. He also previously stated that the baseline for June and July would be 50 basis point hikes, which is 0.5%, but alas, he was wrong. The Fed was wrong in their expectations. The 75 basis point hike that was announced yesterday brings a mixed message for investors to digest. The hike could boost the credibility of the Fed by showing their seriousness about inflation, but it could also degrade the Fed's credibility by showing how bad their expectations and projections have been over the past few months. So after their meeting to raise hikes, they usually release a statement. This is called the Federal Open Market Committee Statement, and it can usually tell us a little bit more about the state of the economy as well as guidance for the remainder of the year. I did some deeper digging on the statement, and what I found was actually quite interesting. First, it noted that economic activity appears to have picked up following the decline in GDP during the first quarter. It also noted no longer mention the highly uncertain effects of the Ukraine and Russian war. However, the statement no longer mentioned the strong household spending and business investment line it used in the May statement. The Fed no longer referencing strong household spending makes sense, as retail sales numbers have been ugly. For the first time in 5 months, retail sales fell, most notably in big ticket items such as cars, which signals that demand is starting to decline due to inflation. When you combine the retail sales decline with the news from Target, Walmart, and other retailers that they have excess inventory, it's clear that the US consumer spending is actually slowing down. Higher interest rates can also negatively affect the valuation of stocks and the real estate market. One of the ways investors like to value a company's stock is to figure out what that stock earnings might look like in the future. They then work backwards from this projection to figure out what it's worth today, and that's actually called the discounted cash flow model. When analysts use that model, they typically use what's called a discount rate, which is typically affected by interest rates. So with rising rates, it actually hurts the value of their future earnings. Since the valuation of growth stocks is heavily reliant on what's going to go on in the future or future earnings growth, the growth sector will be more affected than value stocks. As you can see in this chart, as interest rates started to increase this year, the growth sector has actually suffered more dramatically than the value sector. The bottom line indicates Vanguard's growth ETF, which is comprised mostly of growth stocks, and VTV is Vanguard's value ETF. This is also why in general the stock market has been struggling this year. After so many years of low interest rates, higher rates have basically spooked the markets. In the real estate sector, higher rates will also reduce demand since it becomes pricier to buy properties. We're already seeing a massive shakeup in the housing market. Higher interest rates means that mortgage rates will be greater and houses will be more expensive to the new buyers. If that affects all new buyers, then home prices should come down, and those that own a home might feel poorer and spend less. Since they are spending less, lower spending should equal to lower inflation over time. As you can see in this graph, the 30-year mortgage rate has spiked to levels not seen since 2008, and as a result, mortgage demand has plummeted to the lowest in 22 years, and the home builder confidence index has been falling for 6 consecutive months. Interest rates also affect cryptocurrency. So in terms of cryptocurrency, it's been a little bit crazy this year, as Bitcoin is down like 50 to 55%, and Ethereum is down 67% year to date. These days, crypto has a correlation to the Nasdaq, so if the tech sector isn't doing great, then crypto has also been following that trend. Ironically, according to Morgan Stanley, Bitcoin has a negative correlation to gold, which I thought was pretty fascinating. When interest rates go up, people would rather just take safe bets like the 10-year treasury instead of high-risk, high-reward plays like cryptocurrency. Essentially, the opportunity cost for investing in speculative assets increases as interest rates go up. And I mean, this kind of makes sense, right? Like, why would you take a risk on a speculative asset like Ethereum when you can get a decent guaranteed return in treasuries if interest rates are to rise? So hopefully that paints a really good picture of what the interest rate climate looks like right now. So what are some things that you should do right now as interest rates continue to increase? So first off, let's talk about credit cards. Credit card debt and other loans with variable interest rates will get more expensive. Credit card rates are currently averaging 16.61%, and it's estimated to reach 19% by the end of the year. While fears of inflation and the potential for a recession could make people reluctant to use up savings to pay down debt, it'll actually save you money in the long run as interest payments do add up over time. If you have credit card debt on multiple cards, I would start with paying off the highest interest rate debt first. If you're considering taking out a loan for a major purchase like a home or a car the next few years, it actually might make sense to hold off on these plans and wait to see what happens with interest rates and see if those rates actually come down. If you're sitting on cash, prices might come down at a faster rate than inflation, so your cash might actually have more leverage there, especially if new buyers can't afford a home due to the higher rates. Secondly, I would continue to hunt for higher savings rates. Currently, the average savings accounts rates at banks are a measly 0.07%. But there are online savings accounts that average 1% since they have lower overhead costs compared to a traditional bank. Also, high yield savings accounts will usually offer higher rates as the interest rates tick upwards, so if interest rates keep going up, then the higher yield interest savings accounts should also increase their rates as well. Another thing that you can look into buying is the Series I savings bonds from the US government. The interest rate for those Series I savings bonds is now 9.62%, and it's virtually a risk-free return that you get because it's backed by the United States. You can go to treasurydirect.gov, and the rate is good through October 2022 and even beyond because the new rates are set depending on inflation metrics. There is a limit of $10,000 per calendar year on this savings bond, but the cool thing is that you can actually buy it for other holders as well, like your children. All right, so let's say if you do buy that savings bond, there are 2 key dates you need to keep track of, and that's gonna be in year 1 and year 5. After year 1, that's when you can cash out the bond for the interest, but you will pay a 3-month interest penalty for being so early. After year 5, that penalty goes away because you're holding it for a long period of time. So basically, the government is trying to incentivize you to save through the savings bond to fight against inflation, but it wants you to do it over a long period of time. That actually provides a decent return in the medium term, and it's actually a pretty good option for many people out there that just have excess savings sitting around their bank accounts. If you are interested, I'll link the relevant resources for you guys in the description below. It's just the Treasury Direct website. Now, onto different investment opportunities. By the way, this is not financial advice, but purely what I am personally doing. I personally would avoid investments such as the TIPS or Treasury inflation protected securities and gold as well. As the Wall Street Journal describes it, adding inflation protection to your portfolio now is like buying homeowner's insurance while your roof is on fire. The return you get with investing with TIPS is based on the unexpected changes in inflation expectations. Because the Fed is actively working to bring down inflation, the likelihood of inflation expectations continuously changing doesn't seem that likely. On the other hand, gold hasn't been a great inflation hedge because they typically rise in anticipation of inflation rather than with inflation itself. It seems like every video on finance and investing comes down to this, but the best idea here is to diversify your investments across all different asset types. If your time horizon is for the long term, there's not much to worry about because of perspective. In 10 to 20 years looking back, how will all the prices look today? There's no doubt that there's plenty of uncertainty, but I think that over time, writing out volatility and doubling down on dollar cost averaging into index funds will always be a decent choice, and it's personally what I'm doing, especially if your time horizon is long like mine. Rising interest rates can be painful, but it seems necessary in order to get our inflation back under control. While we don't know what's gonna happen, I'll keep you guys updated, so make sure to subscribe to the channel and make sure to also check out my free weekly newsletter where we cover this type of news and tech news twice a week. Lastly, make sure to grab some free stocks in the description below, and I'll see you guys in the next video. I hope that this was helpful. Peace.